Okay, everybody, welcome to another edition of Real Estate Radio. And we run this program every week. And our special guest today is Scott Picken. He's the CEO and founder of Wealth Migrate. And Wealth Migrate is a real estate platform. And Scott will tell us a little bit about that background of Wealth Migrate and the platform that he's built. Scott has set himself some really lofty goals. He would like everybody to invest into real estate just with $10. It was $100. Scott, we'll talk about that just now. But Scott, maybe just give us a little bit of background where Wealth Migrate started and where you are today, and so give us some insights.
Awesome, Neil. Well, thanks very much for having me online, and it's always great to add value to people. So just in terms of your story, I did my first programming computer course when I was 6, and I did my first property real estate project when I was 13. And I pretty much spent my whole life trying to marry the two industries together. At undergrad level at UCT, I did construction management, and I actually did my dissertation back in 1998 on how technology was going to change the construction and property space. And then I went to London and I did my master's in the same topic. And basically, to answer your question, from a very young age, we did our first development when I was 22, my first London property when I was 24. And all my friends were asking me, how can they participate? How can they get involved in property? And we were trying to figure out ways for people to be able to buy property together using technology. In 2004, I started a company called IPS, International Property Solutions. And in simple terms, we helped about 2,500 people buy houses in England, Australia, America, and South Africa. But we noticed that there was a big gap in the market because the majority of people didn't have enough money for a deposit. If they did have enough money for a deposit, they often wanted to invest in commercial, and then they didn't have enough money for commercial. And thirdly, we had a lot of clients that had the money and even had the knowledge, but had no idea where to invest in the world, or if they found a country like America they wanted to invest, they didn't know how to find the right partners on the ground. And so it was back in 2008, there was a tremendous opportunity, during the last major crash in Wimbledon, where you could buy, there were 48 units, and I could buy them basically for about 50p on the pound, and they were fully furnished, fully tenanted, with about a 12% net cash-on-cash return, which is just, unheard of. And there was only one small problem. I needed 10 million pounds. And I thought it can't be that hard. I've got 2,500 investors. Let me go and, get them involved. But I just couldn't get people to work together. And so I decided then that we had to build a platform to allow people to come together so that they had the buying power of the institutions. And in simple terms, Neil, that platform finally went live in October 2013. So it's been going, now for just over 5 years. We've got members in 133 countries. We've facilitated over $525 million worth of real estate deals, and we've had over $85 million go through the platform, paying back over $8 million in dividends or income returns.
Okay, so Scott, I think maybe what I'd like to understand, the whole real estate industry has evolved, and you took us back right from the start of your career, and you mentioned, obviously, you did your dissertation on in technology, but I think, we've seen technology change all the time. We had, obviously, the dot-com crash in the late 90s, and we still see technology changing all the time, even today. Now, it seems to be that investing is moving into sort of into a different sphere, in the sense of whether we call it a type of crowdfunding or collaborative investing or syndicated. Do you want to maybe elaborate in terms of how would you categorize the kind of investment that gives you the ability to invest offshore without raising deposits and all that kind of stuff in this group? Just maybe unpack it a little bit.
Yeah, so Neil, I think let's keep it simple. So when the internet sort of went mainstream back in 1995 with this, when Netscape effectively allowed users to be able to participate, we effectively had mass adoption. And so what basically started off was media consumption. That's really what, where everyone focused. And then from there it went to e-commerce, where people actually started to buy things online, the likes of Amazon and Alibaba, eBay, where people could participate online. Then we went to social media, And that's where the Facebooks of the world, became relevant. And what we've basically happened over the last 8 years or so is where we've married together now e-commerce and social media, and ultimately we've got social commerce. And so there's really 4 steps, where people have been consuming, then they started to invest online, they've started to take their lives online. But where the 4th step is now moving is towards online investing. So at the moment, there's still a huge amount of consumption in terms of online education, but there's not mass adoption yet in terms of online investing. And yet, for many other areas of our lives, whether we're booking an airplane ticket, whether we're booking a hotel, whether we're buying something online on Amazon, or whether we, anything to do with social proofing, where we use our friends and our peers to give us advice as to whether things are good or bad. Ultimately, that is going mainstream now in terms of the investment space. And so you mentioned a couple of names there, be it crowdfunding, be it peer-to-peer lending, be it fintech, or even collaborative investing, as you've spoken about. And in simple terms, they're all fancy ways of saying the same thing, which is where consumers or investors are coming together and they're using the power of technology to invest online in a safe and simple way. Now there's a lot. Sorry?
No, I'm just saying, Scott, there's a lot of skeptics out there in terms of technology. There's a lot of scams and, that kind of stuff that people get exposed to and that kind of stuff. And we hear all the bad luck stories or the negative stories about people, putting money into a so-called fund that's in a tech fund or online or through a platform into real estate, and they lose their money. So what is the assurance that investors that come onto your platform get coming through the Wealth Migrate platform?
Yeah, so I think there's 3 ways that I would answer that, Neil. The first is that technology is only an enabler; it's not a fix-all. Okay, so what I mean by that is that technology makes the process more efficient. If you and me were to buy a house in wherever in Cape Town, the way we would normally do it is we would put an SPV together. If you put in 70% of the cash and I put in 30% of the cash, you would own 70% of the SPV, I would own 30%. So SPV is a special purpose vehicle. And that company, generally your company, would own 100% of the property. So you would own 70% of the property, I'd own 30% of the property. We would then agree, who's going to get the mortgage. We'd agree who's going to manage the property. And we'd agree how we're going to exit the property. Would you agree with me, Neil, that if you and I were going to buy a property, that would be a pretty standard way of us buying a property together?
Sure.
Okay, so all that we've done is put technology over the top of that, so that, in the past, you and me would have had to know, like, and trust each other. Now, by using technology, you and I don't have to know each other necessarily to be able to invest. So the first thing that I want to say is that technology is not a fix-all. It's purely an enabler. It purely helps you do it in a far more trustworthy and transparent way. So take another metaphor. If you take Uber, in the past, if you caught a taxi, it was very inefficient. Often they would take you, the long way. If you were in London and you didn't know where you were going, they would take you the long way around and charge you a lot more money. And if you left your cell phone in the car, there was absolutely no chance you would ever get it back. Whereas with the likes of an Uber, because you've got far more transparency, they've got your credit card, so the driver is safe. It always blows me away when there's women, driving late at night in Uber, and they feel safe to be able to do it. And technology allows them to have that safety. But equally, I've left stuff in my Uber before, and I've never had a problem getting it back. So again, transparency of sorting that out. So that's where I believe that technology is a massive enabler in terms of leveling the playing field. So that's the first thing. The second thing is that with regards to scams, etc., is that they certainly exist, and whether you use technology or whether you do it just in the traditional investing way, people need to be able to do their due diligence. And there's 3 ways that we basically have found a way to, nothing can be guaranteed, but to try and avoid that. And that's just based on decades worth of experience of our team to try and avoid that. The first is that we only deal in countries where we already, understand the country, we understand the laws, we understand how it works, et cetera, et cetera. So at the moment, we're only in England, Australia, America, and South Africa. All three of those markets, we've been investing for more than a decade plus. And so we know how it works, and we know that the legal systems protect you, et cetera, et cetera. The second thing is that we look for partners with a long track record. So although the internet, again, is an enabler and technology is an enabler, there are plenty of property or real estate partners out there that have a 10-year plus track record, and they can actually show you how they performed during the last crash. I always say when it comes to property, you're not investing in the property, you're actually investing in people or partners. And you shouldn't be judged by how it goes when it's working. You should be judged by how it goes when it's not working. Because if anyone's ever dealt and invested in property, they'll know that at some point something's going to go wrong. It's pretty much guaranteed. And so you need to be able to have partners that have the fortitude to fix the problems. And so for us, it's very much about vetting the partners and looking at their track record over time and how they dealt with not only the good times but the bad times. And then the third thing, critically important,
I just wanted to say that
we tend to gear the project, not aggressively. So we'll look at loan to values of anywhere from 50 to 65%. But by bringing in a third-party bank, it's adding an extra level of due diligence on the specific project to ensure that the T's are crossed, the I's are dotted and the T's are crossed. So, I know it's a long answer to your question, Neil. But again, in a traditional environment, those are the ways that people, do their due diligence to make sure that they're not being scammed. We are following that traditional environment, but using technology as an enabler so that it's a lot more transparent for people, so that they've got access to the right information so they can make the right decisions for them and themselves and their family.
Absolutely. So, Scott, maybe you want to tell us a little bit about, in terms of how you do due diligence, first of all, on the property, because a lot of investors put a lot of emphasis on the real estate itself. You did mention, of course, that you've got to have the right partners on the ground, which is great, which is, I think a lot of people forget that you've got to be a good investor to identify a good property and spot a good property. So my question is twofold. First of all, how do you select the right properties? You mentioned you're selecting in terms of due diligence. And secondly, surely there's got to be some kind of educational process for the investor. Because first of all, they're going online and that kind of stuff. How do you deal with those two things?
So Neil, I having done this for a long time, since my early 20s, I actually wrote a book in 2014 that got endorsed by Clem Santa called Property Going Global. And I mean, people can still go and read it if they want to. It's literally propertygoingglobal.com. And in that, we created a system, a 4-dimensional model called GIDS, Global Investment Due Diligence System, to enable people to be able to make the right decisions at a macro level. So, which country to invest in, at a micro level, which city to invest in. It takes into account currency and currency devaluation. And then ultimately it gets down to the analysis of the specific property. And whether it's a residential property, we've got the 100-layer system in terms of the residential side, or whether it's a commercial property, we've got a due diligence checklist of 142 point items on a commercial property. So, I mean, there is a huge amount of specific detail that one can go into. But what I think is critically important for people to understand is that it actually comes to your second point, which is, how do people actually get access to that knowledge? Where's the transparency? And that's where I believe that the technology is so valuable, because if someone is an expert in Cape Town and they're an expert in investing in commercial property in Cape Town, there's going to be quite a good chance that they are not going to have the market expertise or the local knowledge to be able to invest in Johannesburg. Would you agree with that, Neil?
Absolutely.
Okay. Yeah. So the chances of them being an expert and investing in Sydney, London, or New York is virtually impossible. In fact, there's no real estate investor in the world that can claim that they are a local expert in every market. It's impossible.
Sure.
Okay. So really where technology enables people is that you can have the fundamental expertise, but I always believe that real estate is always going to be a local game. You've always got to have local market knowledge. And therefore, where the sort of the big funds or the REITs, try and do everything themselves, and they try and have all the in-house expertise and make all the right decisions based on their area of expertise. Where I believe technology can take that to the next level is that it allows people to participate with local partners who have local knowledge but within a global trusted framework. And so that's what we aim to do, is to find those local partners. And I believe that you can have the best due diligence system in the world. You can have the most sophisticated investment committee in the world, but wherever that investment committee is located, it's no ways that it's going to have the area expertise of a qualified local partner with a good track record. Because there's just no ways. They'll never have the same knowledge, basically.
No, absolutely.
So it's about finding those local partners, vetting those local partners, and then allowing them to also bring their expertise. But remember what I also said earlier, backing it up by, if you're getting financing from a bank, then they're also going to be crossing the T's and dotting the I's to make sure that everything is above board.
Sure. So, Scott, if we look at the macro environment worldwide, it's probably, from an economic perspective, not in the best place right now. I mean, if we start, unpacking each country, we start looking at the UK. I mean, there's issues with Brexit, and I mean, it's definitely having an effect on the overall UK market. If we start looking at the US, we've got this trade war with China going on between Trump and China, and we look at also Australia, and sort of on that side, which is the markets you're kind of operating in. I mean, the macro environment is probably not in a good space, as it is in South Africa, which we're not in a good space either. So for somebody that wants to invest, how would you say they would approach that? How would they get to that minefield of the macro uncertainty?
Well, just before I answer your question, Neil, and I'd like to get some clarity on what you're asking. When we talk about macro uncertainty, my perception is that we're talking about the world at large, and whether we're talking about the property, the stock market, the bond market, or anything in between, it's all uncertain. It's not like the real estate market is tough in England because of Brexit, but the stock market's booming. So I just want to clarify: are you in agreement with me on that? That we're basically general uncertainty, full stop.
Absolutely.
So that I just wanted to make sure that we had the same understanding. So then the second point is that what I've learned from some of the wealthiest people in the world, having worked with them for the last 20 years, is that generally the middle class sort of professionals, and to some extent even high net worth investors, want to focus on capital growth. They often are looking for projects where it's about the capital growth. And what the challenge is with that is that they are often very susceptible to market corrections. And every market cycle goes up or down. There's plenty of very wise people, a lot wiser than myself, that talk about these cycle trends happening in 8 to 10 year periods. And to your point, the last crash was 2008, 2009, and we probably are very much due a correction. So that for me is the second point, that let's not be naive. We are due a correction, and often people's mindsets, even Bitcoin. Why do people get in Bitcoin? It's not because they earn an income; it's because they want to get capital growth. Okay? And it's a classic example. Like you say to someone in Cape Town, "Why do you buy a house in Cape Town?" They go, "Oh, because I get great growth." And you go, "Well, do you get good income?" And they don't. I mean, there's no ways that someone can tell you it's an income play because it's about capital growth. And unfortunately, it's that capital growth that then makes them susceptible to market swings. The third thing that I think is absolutely critical, and whether you're looking at the stock market and you're looking at Warren Buffett and the fact he likes to buy Coca-Cola because Coca-Cola pays good dividends, or whether you're looking at property, you need to be looking for income-producing assets, because if you look for income-producing assets, they are far more resilient to economic corrections. And in fact, what I watched in the last crash was that wealthy people that had invested in income-resilient investments actually had the cash to then go and buy distressed assets off middle-class investors that were trying to go after capital growth and basically on the wrong side of the equation. Now, when I say middle-class investors, please understand that some of the biggest property funds and the REITs are also run by sort of middle-class mindseted people, and some of the biggest property funds were also chasing capital growth. And when the market corrected, the property funds didn't sell their worst assets; they had to sell their best assets to be able to recapitalize their portfolio. It's the same mindset. Whether it was Joe Soap, being bankrupted in America and foreclosing on his house, or whether it was some of the biggest property funds, losing their best assets as well. And so
Right.
to come back to your point, Neil, is that I think that as long as we've got the assumption of those three major things, people need to be aware that there is going to be a market correction. If they're focusing on capital growth, it's like betting against winter. It's going to come at some point. And the third thing is that if they focus on income resilient investments, then they can weather the storm. Now, a good example of weathering the storm, and you've been there with me. I mean, you and I have done this together when we did our buyers trips in America. Was that back in 2009, I'd helped about 2,500 people, as I mentioned, buy houses or apartments. And I remember meeting these two very wealthy gentlemen, and they were buying medical buildings. And I said to them, well, why medical? And they said, well, think about it. No matter what happens in the global economy, people need doctors. I was like, okay, that makes sense.
Yeah.
Secondly, doctors never leave their premises. And I thought to myself, geez, if I go back to when I was a child, in my case, my doctors passed away, unfortunately, but the premises are still medical premises. And the third thing is the doctors are hell of a good at being doctors, but they're not good, they're not accountants. And so they signed very good long-term favorable leases. And I remember sitting back in 2009 and thinking, I have an honors degree cum laude, I have a master's degree cum laude. I'm supposed to know a little bit about this. And yet, why has no one ever taught me this? Like, it's such common sense. And ironically, when you and I were in America, and I remember we were together, and we started meeting some of these medical partners, and I said to them, what happened to you during the American crash? And I mean, some of those markets in America lost anywhere, the residential markets lost anywhere from 40 to 70%, if you remember. Places like Vegas lost 70%. And these medical guys said, no, we didn't lose one tenant. So even though the capital value arguably might have gone down, their income, they didn't lose 1 cent in income. And so they just weathered the storm. And once the economy starts to recover and everything else, the capital growth goes up. But as long as you don't sell, you don't lose anything. So I love to use that. It's a real life story. I mean, you and I met the guys, Paul and Bruce and them, we were on the ground together. And I remember thinking, yes, so you take like the worst crash in American history since the Great Depression, and, commercial resilient buildings like that just weathered that storm. And I find that fascinating. And the last thing I would say, when you bring up some of the uncertainties in England or Australia or America or even South Africa, is that often uncertainty presents opportunity. And so if you can find the right partner and you can find the right resilient investment, be it in the stock market or in the property market, I'm agnostic. Often it's in times of uncertainty where you pick up really good opportunities, and that's where you've got to A, have the knowledge, and B, have your eyes open for opportunity.
Absolutely. So I think, Scott, I think that also comes down a lot to your due diligence process. Because if we had to look at, I think you've kind of identified trends in the market, and in particular, you've identified, this medical sector that is a performer through good and bad times. And I mean, there's other REITs, for example, also doing really well in the logistics sector, and it's a worldwide trend. People, the holders are doing pretty well. It's a good sector. And I think it comes down to, doing the right due diligence and then obviously offering that to the investors out there. I would assume you've got some medical stock on your platform.
No, very much so. So we've been very strong in medical for all the reasons that I've mentioned. And I mean, if people go to the platform, they can actually, there's a deal at the moment in Atlanta where people can participate. We've actually got over about 100 and I don't know the exact number anymore, but it's about $120 million worth of medical commercial real estate in America. So we've got a long track record there. I like what you say about the logistics sector. It is very much one of our core areas of focus. We had a project there in Australia in that sector, and we've got one coming up. We don't have one live at the moment, but there's another one coming up live in the next couple of weeks and months in Australia. And so we're always looking for economically resilient areas. In London at the moment, we've got an opportunity which is a residential opportunity, but rather than it being a single house or single apartment, we're actually buying the whole building. And so it's got multiple income streams, which again makes it very, economically resilient. And, it's 200 meters from a station. It's 30 minutes commute directly into London Bridge, which is the heart of the financial capital. And so these are the type of things, Neil, that I think you are spot on mentioning, because it's not just about cherry picking an opportunity. It's about cherry picking an opportunity that's in a sector which is going to be resilient.
Yeah. Absolutely. So, Scott, let's get on to the transactional side. I mean, if somebody wants to start investing on the Wealth Migrate platform, for example, they're keen, they say, listen, I like what you say. I like the kind of investment sectors that you've identified. I understand you can use cryptocurrency, right, to invest in your stock. Is that correct?
Yeah, so Neil, we used to be able to do that. We've actually stopped it in the short term. So we were using a system called BitPay where people could use cryptocurrency to invest. We evolved our platform from version 4 to version 5. And in that process, not that many people were using the BitPay functionality, and it was quite expensive. And so it's one of the tech things that sort of didn't come across from version 4 to version 5.
Right.
And the reason being is that the underlying investment is still fiat. If you're investing in America, you're investing in US dollars. If you're investing in England, you're investing in pounds. If you're investing in South Africa, you're investing in rands. And so, look, that's a whole nother podcast on its own in terms of the future of real estate and tokenization and security tokens and everything else. It's definitely where it's going. I have absolutely no doubt in my mind. However, at the moment, we're still really helping people invest from a traditional perspective directly into the real estate.
Okay, so just give us the minimum amounts for somebody, because there's no deposits and all that kind of stuff, as you mentioned right at the start. I mean, what is the entry-level investor? What kind of money we're talking about to break into, say, for example, the US market, into a medical facility in Atlanta?
So Neil, I think there's two things there that you mentioned that are important. So the first one is that the minimum investment. So if someone goes onto the platform, it depends per project, and it can range from anywhere from $5,000 to $10,000 as a minimum investment. However, on the first Wednesday of every month, we actually have a bit of a festival, every Wednesday, on the first Wednesday of every month, where we drop those minimums down. They can be as low as $1,000, and we're actually beta testing $100. Okay, so on every Wednesday, the first Wednesday of every month, we drop it down for one 24-hour period to really drop the barriers to entry for anyone to be able to participate and be able to get involved. So, I mean, people can look out for whenever the next, the first Wednesday is of every month, and we call it Wealthy Wednesday, and it allows people to be able to participate. But generally, if people go to the platform, it depends on the specific projects and the partners as to whether their minimum investments, tend to range between $5,000 to $10,000. That's the first thing in terms of answering your question. The second thing, which is quite interesting, which I do want to highlight because I think this is very important, is that if anyone's done any courses, I know you've done a huge amount of work with Rich Dad Poor Dad as an example, and I wanted to ask you, Neil, what does OPM stand for in your mind?
Other people's money.
Other people's money. So we're taught all around the world to use OPM, other people's money. I think I first learned that from probably Dr. Dr. Russ or Robert Kiyosaki. I don't know who it was, but it was one of them. I tend to joke with people. We've taken that to another level in terms of OPM, because we actually talk about OPM being other people's mortgages. Okay.
Right.
And why I say that is that, and you know this, Neil, you and I were in America together. It was impossible to get a mortgage in America unless you were an American citizen. Now, I've been buying property in England, as an example, since 2002. And I just tried to buy a property on my own and get a mortgage, and it was an absolute nightmare. In fact, it was easier to get my bloody master's than it was to get a mortgage. And in Australia, it's impossible. Whether you're Chinese, South African, Italian, English, it's irrelevant. No one in Australia can get a mortgage unless they're in Australia.
And I don't think it's going to get easier.
Exactly. So my joke on OPM now is that if you want to invest, even in South Africa, it's, when you and I started investing, Neil, we could buy house after house after house, and the banks didn't even talk to each other, and et cetera, et cetera, et cetera. And so you could build up quite a portfolio quite quickly. Whereas in South Africa now, it's very, very difficult based on your earnings, and they don't take into account the income that's earned by the properties and a whole bunch of other criteria. So it gets harder and harder and harder to get mortgages. And by using the platform and by partnering with qualified partners, they're the ones that are actually getting the mortgage on the property. And so to come back to your question is, what is the entry level? It's not only about the money. You don't need to have to get a mortgage anymore because the property and the partner already has a mortgage. You don't need to have to worry about management or maintenance, tax structures, bank accounts, or any of all the other usual hassles that are involved in investing. All that you need to be able to do is participate in the deal, whether it's $100 or $1,000 or $10,000, or we've had clients invest millions of dollars. in the deal. And why do they do it? Well, they get access to qualified, quality partners in a good opportunity where they don't have all the hassle of organizing the mortgage and everything else. So it's quite a long answer to your question, but it's really important that people have that level of understanding.
Yeah. Okay, Scott. So I think you've kind of jumped onto kind of a new trend, and I think we could have this discussion probably into late afternoon. Unfortunately, you are limited in a little bit of time, and I just want you to give some closing comments on investing in particular into your tech platform and people's fear around getting onto that platform, and I think more importantly, if somebody puts their money in, when do they get it back? Maybe just give that as a bit of a closing statement. And I think what we can do at a later stage is to have another podcast on another level, getting into the educational side of things. But maybe you just want to share that in terms of that, giving people that confidence to go into tech and say, listen, if I put my cash in here, it's going to go in US dollars, etc., go to the UK and pounds, whatever. What can I expect in terms of return? When will I start getting my returns? How does it work?
No, great, Neil. So look, I think the beauty of technology nowadays is that if you wanted to buy a house in London, when I started helping people invest in the early 2000s, you really had to bet the farm, on one deal, because just the deposit alone was 70 to 100,000 pounds plus, and you still had to go and get a mortgage and everything else. And so it was a huge amount of money, a huge risk before you actually knew whether it was going to work. And the thing I like about technology now is one can dip one's toe and get started and test it without having to bet the farmhouse, which I think is really quite important. The second thing is that, we've got different types of deals. So we've got an income producing deal, which is where people invest in a deal like that medical deal that I spoke about, or like that London property that I spoke about. And they will basically, they put their money in, the property transfers, as in, they own the property, and they'll earn their first dividend after 3 months, and they'll effectively, get paid every 3 months. They'll get paid an income return on the asset. Generally, it's a 5-year hold, so we hold the asset for 5 years, and then we have an exit strategy or a liquidity event after 5 years. So they will get their income return every quarter for a 5-year period, and then they'll get their capital plus the capital growth back after a 5-year period. So that's the one way of doing it. The second way of doing it is what we call a growth project, and that's where you invest in something like a new development where there's not actually, the income that's being earned. They put their capital in. It might be an 18-month to 24-month period, and then they exit the deal, and they make a profit basically in terms of that. And then the third type of deal is actually a debt product. I'm quite excited. We've got a debt product launching now in South Africa, in Cape Town, where they actually put their money in as a debt, so they don't earn the capital growth. They purely earn a debt. They take first mortgage over the property, and they get paid a interest return. And I mean, in the case of the deal that's going live in Cape Town, it's about an 18% return that they would get, and it's quite a small time frame. It's sort of 18% is the annual rate, but the actual holding period for the investment is 6 months, 5 to 6 months. In terms of that process. So I don't know if that answers your question, Neil.
Yeah, no, absolutely.
How long is it?
I'm speaking on behalf of all the other investors out there. I mean, that typically is the question I would ask. Scott, I think as per usual, it was great chatting to you. I think there was some really great insights, and I think going forward, we'd like to set up, another discussion around this, because it's really cutting edge, and I think you're the kind of person that likes to stick with the latest tech, be at the forefront of that. But more importantly, I think to give your investors great returns. So, Scott, thank you very much, CEO of Wealth Migrate. Really great chatting to you.
No, Neil, I really appreciate it, and I do hope we get another chance to chat. But one thing I would say to people is that we also created the inner circle. So for those people that are nervous or scared or whatever, we created a wealth inner circle where people can join. They can get the knowledge, they can be part of a community, they can learn while doing. And I mean, it literally costs $250 a year. And for that, they get a $100 voucher to be able to invest in their first deal. And so it's a very entry-level way of being able to dip your toe, to join a community of people and to get going. So I truly believe, Neil, something I'm very passionate about, and I'm very grateful to be able to spend time with you and your listeners, is that, the barriers to entry are being removed completely now. And I don't believe people have excuses anymore to not participate. Whether it's in us or anything else, I'm agnostic to that. But I do believe people can take control of their financial destiny now, which is fantastic.
Excellent. Scott, wonderful chatting to you. We will chat to you in the future, and to everybody, please tune in to this once a week. Thank you again, Scott. We'll chat soon.